On the next page, on page 38, top of the page, we have some policies, top of page 38, that are whole life policies, but they're kind of specialized, created for specific uses. So we have that first one there, which is called joint life. Now, we mentioned this earlier when we talked about buy-sell agreements and Ben and Jerry. This is a policy, and usually it was utilized for husband and wife. Covered more than one person. So say we had $1 million death benefit, or face amount. Pays out one death benefit, pays out when the first party died, called joint life. So on the exam, if they ask you, joint life policy pays out when what party dies? Answer would be the first person. So my example, husband dies first, $1 million gets paid out, coverage is over. So as you can see there, it's obviously going to be cheaper than buying two individual policies, one covering the husband, one covering the wife. So we've got $1 million of coverage there. That's a joint life policy, sometimes called first to die. Now, similar policy, but different in nature there, is called survivorship life or last to die. Works just the opposite. $1 million face amount, husband dies, nothing gets paid. Wife dies, face amount gets paid. Okay, pays out when the surviving spouse dies. Now this one, survivorship life, is commonly used to help pay estate taxes, which is due upon the death of the surviving spouse. So remember, it's death-free, it's used in estate planning, it's a death-free benefit used by the heirs of the estate to pay that estate tax. So we're talking about wealthy people. Face amounts usually at least $1 million or more. Then we have the next heading, juvenile life policies. So parent buys life insurance on a child, parent's the owner, child's the insured. Remember, we don't need permission of the child to do this. Juvenile life is, by definition, life insurance purchased on the life of a minor. So minor dies, death benefit gets paid to the parent. Sometimes they're referred to as jumping juvenile policies, and in a jumping juvenile policy, once a child reaches a certain age, such as 18 or 21, the policy limits will automatically increase, and the child can then at that point take over the policy with an absolute assignment from the parent. It's a cash value policy though. Okay, so whole life, done. We got whole life done. That's it for whole life. And we go to the next one, endowments, which we skipped over back on the bottom of page 35 in the text there. Now, bottom of page 35, endowments, 1 or 2 test questions usually on endowments, but by definition, what we'll need to write up there, most expensive type of life insurance. Not permanent life insurance, but most expensive. This policy does have a cash value. Okay, so loans, you cancel the policy, you get your money back, but you might have to pay tax on the interest. Okay, so all that stuff applies there as well. But it's the most expensive type of life insurance. Now the good news about endowments is we already covered them. Now how do we already cover them? Well, remember when we talked about the first type of whole life policy in this section? We talked about continuous premium or straight whole life, and I bought it when I was 30, paid the premium every year till I was 100, policy matured at 100, so on and so forth. Endowments are almost identical to that with one exception. The policy matures prior to 100 at a predetermined age, predetermined by the person buying the policy. So for example, if we had an endowment at age 65, we're taking that continuous premium policy, shrinking it from age 100 to endow or mature at age 65. So we pay a level premium every year from whenever we purchase it till age 65. Life insurance coverage till we purchase it, until we die, or age 65, whichever of the two occur first. If we live to 65, the insurance company sends us a check for a cash value or death benefit, whichever of the two is higher. We pay tax on the difference between what we paid in and what we receive. Okay, we subtract our cost basis there. So endowments are exactly the same as straight traditional whole life. They just endow or mature prior to 100 at whatever age the person wants. Endow at 75, 95, 45, 55, 65, whenever they want. But remember, most expensive because we're paying all that premium during that period of time. Okay, so we're shorting the premium payment up significantly from whole life, from age 100 to whatever age we want it to mature at. So last paragraph on the page, highlight that first sentence. Endowment's always the most expensive type of life insurance. And we go from that to term, which starts out the section on page 33. Term is the cheapest type of life insurance. And we'll get all that off of there so that we can use this space. We'll finish all three. and we go to term, which we'll list up there, cheapest and no cash value. So cheapest type of life insurance, no cash value in the policy. That eliminates pretty much everything. So sometimes they say term is pure protection. Well, that's true, because the premium you pay, all of it goes to the cost of death. So we have a couple different types of term, and they start out the section there with what's called annual renewable term. So annual renewable term is a 1-year term policy. And that 1-year term policy is the period of protection. So say a person is age 30. They buy an annual renewable term policy. Covers them from age 30 to 31. They pay a $100 premium. They get $100,000 of coverage. Cheapest type of life insurance. Temporary. Term means time. Now, term policies generally are seldom sold beyond age 65, because every year you get older with term, the higher the risk goes. So remember, there's no cash value, nothing to offset the insurance company's risk, so pure protection. Older you get, the more expensive it goes. However, in the short run, it's the cheapest type of insurance. The longer you keep it, though, the more expensive it becomes. So this person buys it when he's 30, pays a $100 premium, annual renewable term policy. When he hits 31, if he's still alive, he has the option to renew it. Don't assume the term policy is renewable unless they state it is in the question in the exam. So here I said, it's right in the name of the policy, annual renewable term. And it'll tell you it's renewable to a certain age. Renewable to age 50, renewable to age 65. So annual renewable term. Now once we hit 31, we can renew it, 30 to 32. What's going to change when we renew it at 31? What's going to go up? The premium. The premium will go up. So where we paid $100 when we bought it at age 30, we might have to pay $175 at age 31. Why? We're 1 year closer to death, right? Okay. Now, say we die in between age 31 and 32. What's going to happen? $100,000 goes tax-free to our beneficiary. Death benefit. Okay. Now what happens at 32 if we don't want it? Because we know if we renew it at 32, it might cost $240 to renew it at 32. What if we don't want it? We don't have to renew it. Do we have to go through a physical exam to renew it? No. And in fact, when we buy it here at age 30, it's stated right in the policy what our renewal premium is going to be. Okay, so we know. So why would you buy term? Well, it's the cheapest. And you only need life insurance for, say, this individual needs life insurance for a temporary period of time. That's why they would buy term. Okay, so annual renewable term. Well, renewable term is also sometimes convertible. Okay, so here's what convertible means. Convertible means you can convert from term to whole life. Why would you want to do this? Well, maybe you decide you want permanent insurance and you don't want to have to go through underwriting to get it. Convertible term is convertible at any time from term to a more expensive type of life insurance. You cannot convert from term to term. So if it's convertible term, which again, don't assume it is unless it says it is in the question. I can convert from term to a more expensive type of life insurance. So term to whole life. Now remember, it's whole life, so it's going to be much more expensive. Now there's a couple limitations here though. When I convert, I can only convert to a maximum of the amount of coverage I had in my old policy, which was right here, $100,000. Also, when I convert, remember, it's not based on my health. I could be sick, I could be dying, I could still convert. The premium I pay for this policy is based on my attained age, which is my age at conversion. So say I bought this annual renewable term policy when I was 30. I convert when I'm 39. Well, then my premium for this new conversion policy is based on the age of 39, not age 30. But not on my health. If I have a health condition, it doesn't matter. It's based on my age only. Only convert to a maximum of $100,000 or whatever I had in the previous policy. That's a limitation there as well. Now, one thing back here to the term, which we talk about, there is sometimes included in the term policy what's called a re-entry option, which they sometimes ask questions about on the exam. And the re-entry option is this, if it's included in my policy. It allows me at renewal to go take a physical exam and prove that I'm healthy. Now, if I am healthy, the re-entry option will allow me to renew the policy at a reduced renewal premium. That's what the re-entry option affects, the renewal premium. So you've got to know that for your exam. And that's the re-entry option there. Okay, so we'll take a look in the book here real quick and make sure we get everything. Top of page 33, level term number 1, annual renewable term. Highlight in that paragraph, no physical exam is required to renew it. Now remember, a 1-year policy, renew it up to a certain age. What's going to increase when you renew? The premium. Coverage amount always stays the same. 2, level premium term. Now, it's very similar to annual renewable term, but level term is for a period longer than 1 year. So if you want 5-year term, level term, you can buy it. If it's renewable, then when it renews, it would renew for another 5 years, and that's the point where the premium would increase. Re-entry option, second paragraph from the bottom. So when we have renewable term, if we have a re-entry option, if we can prove that we're still healthy, it would have the effect of reducing our renewal premium, as it says there in that paragraph. And then we get to decreasing term. Okay, now a couple test questions maybe on decreasing term. It's becoming a lot more prevalent than it has been in the past due to consumer loans. But well, let's give a good example. Mortgage. Okay, I get a 30-year mortgage, and my mortgage amount's $500,000. And I could also take out a 30-year decreasing term policy. Base amount, $500,000. However, the decreasing term coverage amount goes down. The death benefit decreases. That's what decreases in decreasing term. However, that's okay. That's what it was created to do. Because when I get my loan, as I make my loan payments, what happens to my loan balance? It goes down. So this is fine because I purchased this decreasing term policy specifically for one reason, and that was when I died, I wanted it to pay off that mortgage. I don't want to leave my surviving spouse with any mortgage payment at all. I want them to have the house free and clear. So this protects me, number one. Who else, though, does it indirectly protect? This would be the lender. Okay? So the lender is indirectly protected, and in fact, they're usually listed as the beneficiary in the policy. Okay? So it pays right off to them. So mortgage protection insurance, you buy it, it's decreasing term. Now also you see decreasing term utilized in what's referred to as credit life insurance. Credit life insurance, so different states have different requirements on that, but usually credit life insurance can be written on a loan that doesn't exceed 15 years in length. So it's marketed as credit life, but it's really the type of policy providing the coverage is decreasing term. Okay, so again, the lender is going to be the beneficiary there, and we'll talk about that at the very end of this section. So we go on to the next page, and we've got on page 34, we have the top of the page, second paragraph, there's convertible term. So he said he could convert from term to a more expensive type of policy, endowment, whole life, conversion, not based on your health. Premium you pay those based on your age, at attained age at time of conversion. And then also, you're limited to the amount you could convert to based on the amount of coverage you had in the old policy. Okay, so we've got convertible term there. We're done with term. And we can go ahead to page 38. Now we see right in the center there on page 38 is group life insurance. Okay, so again, we're covering all our bases here in this section with the different classes of life insurance. We just finished all the different types of ordinary life insurance. Now we go into group. And when we talk about group life, we're going to talk about it as an employment-related group. Okay, so we've got the group policy here. We've got 3 parties to the contract. We've got the insurance company, or 3 parties involved related to the contract. Insurance company, employer, and the employee. Now, first question. Is group life insurance required by law? The employer provide this for the employees? What do you think? The answer is no. Workers' comp is required in most states, but group life insurance, group health insurance in most states is not required. So it's completely at the option of the employer. So if the employer decides to purchase this, they purchase it from the insurance company. So the actual contract is between the employer and the insurance company. Now, the employer receives what's referred to as a master policy. Eligible employees receive what's called a certificate of insurance. Test question may be on this and maybe on that. Master policy is the policy that the owner of the policy receives. Certificate of insurance, that's the proof of coverage for the employee. Now, I mentioned eligibility, eligible employees. Who sets eligibility for the group? Insurance company or the employer? What do you think on that one? Answer there would be the employer. Remember, they're buying the policy, so they can determine who can enroll. For example, you might have to be a full-time employee, you might have to have worked there for a certain period of time before you're eligible to enroll. Those are eligibility requirements. Okay, so we see how that lays out. Now let's give an example. Say that I have a group with 1,000 employees. I own this company, 1,000 employees, and I come in to see you because you specialize in selling group life insurance. And I say, hey, I want to buy a group life insurance for my employees, and I want to buy it from you. And so you sell it to me. Now, question that I'm going to ask you, what type of life insurance would I buy? So I have the options. I could buy whole life, endowment, term. If you were the employer, what would you buy? Term, because it's cheapest. So most group life insurance is annual, renewable term. Okay, so I'm going to get some term. So I come in to see you, say, hey, I've got 1,000 employees. They do a really good job for me. I want to purchase some group life insurance from them, and I do. You sell it to me, and you give me all the forms, and I say, hey, I'm going to meet with them tomorrow and have them fill out all the enrollment forms and all that good stuff. Now remember, group insurance, generally low, if any, underwriting in comparison to individual, which a lot more strict underwriting. Okay, so I meet with all my employees tomorrow, 1,000 of them. They're all young. Okay, they're all in their early, mid-20s. And I say, hey, I've got this group life policy. Anybody that enrolls will get $15,000 of coverage. Okay? And I tell them that they will have to pay a portion of the premium. Okay, so the premium's going to be shared. So we'll call that and it is called a contributory group, where the premium's shared. And I call you up the next day. You're the one who sold me this policy, and I say, hey, I've got 3 big ones for you. You say, well, what does that mean? What's 3 big ones? I said, well, out of my 1,000 employees, only 3 want to enroll. Guess why? They're dying. And they know it. Now, why do you think all the other employees didn't want to enroll? 997 of them. Why did they not want to enroll? They're young. They're never going to die, so they think. And they don't want to pay any of their wage towards life insurance. What a waste of money. So these 3 people, though, they said, hey, what a deal. Free life insurance, no underwriting, and I'm going to die. Might as well take it. What's that referred to? What do we call that? From the insurance company standpoint, that's called adverse selection, right? Adverse selection. Okay. Well, we don't want this. You say, well, that's great, Scott, but that's adverse selection, and a certain percentage of the employees have to enroll, and it's based on how the premium is paid. And since it's a contributory group where you and the employees share the premium, 75% of all eligible employees must enroll. Well, based on my eligibility guidelines, we'll say everybody's eligible for coverage. Okay, so you tell me 750 of my employees have to enroll. So I have to get another 747 people to enroll. And I say, well, why don't I do this? What if I changed it from a contributory to a non-contributory group? Well, what does that mean? That means the premium is 100% paid for by the employer, me. And if I do that, how many people must enroll now? 100%. But why not? It's free. So I say, okay, I meet, next week I say, hey guys, I'm going to pay all the premium, all of it. So you don't have to worry about that at all. So everybody's getting $15,000 free life insurance. Everybody enrolls. I meet the participation percentages. If the participation percentages are not met, policy will not be written. The policy can be canceled. Okay, so this is kind of like the introduction here. The only last thing that we would talk about would be, say you're one of the covered employees, or say I'm one of the covered employees. Okay, so the policy gets issued and sold, and you come to my office to deliver this policy to my employer. And we cross paths in the hallway. And you notice I'm kind of limping along the hallway there and look real pale. I'm coughing and foam coming out of my mouth, all this gunk in my eyes. And you try and stay away from me because you don't want to get sick. And you come in to meet with my boss and say, here's the master policy. Everybody's covered. Everybody enrolled down here. Everybody's covered except that, sicko that was walking down the hall. We don't want to cover him. Okay? Can the insurance company do that? Can they exclude a member based on their health? Answer, no. If a person's eligible, they have to be covered. And that's where you see a lot of times on the health insurance side, people taking a job just to get the insurance because for certain health reasons, maybe they're unable to purchase it on their own. Now, say that I'm covered though in the group here, and I decide I'm going to leave the group. For whatever reason, I quit, I get fired, whatever reason it is. I have the option to convert to an individual policy. And remember I said up here, annual renewable term. It's also convertible. I can convert from the group to an individual policy, whole life or endowment. Remember, those limitations still apply. There's no underwriting, but my premium is based on my age at conversion and my attained age, and also it's whole life, so it's going to be more expensive. So I can convert, but I'm limited in the amount that I can convert to based on the amount of coverage I had in my old policy there as well. Okay, now that's the group policy. One last thing I'll mention on underwriting. Remember I said there's hardly any underwriting in a group policy. They consider if you're healthy enough to work, it's good for everybody. Well, what if they did request everybody do a physical exam though? Okay, so say they requested all 1,000 people go do a physical exam. Who pays for that? Who pays the costs associated with that? Would the employer have to pay them out of their pocket, or does the insurance company pay that? Well, think about it. The insurance company pays that. Okay, so you want a free physical, go apply for an individual life insurance policy. They'll send you to go do it. Remember, you got a free look, right? Well, they pay for the physical exam. It's a cost of underwriting. So yeah, true, it's reflected in the premium, but they pay that cost. Okay, on page 38, then bottom of the page, number 2, coverage is usually written without requiring a physical exam. We said if they required it, then it would be very expensive. And they're selling insurance to the masses here at a discounted rate, so they're not going to do that. We have number 3, master policy. So term, star that, is issued to the employer. Star this next one, maybe on the test. The contract is between the employer and the insurance company. Next one, certificates of insurance are issued to the individuals covered, stating the amount of coverage and their designated beneficiary. And then we have number 5, talks about contributory group, non-contributory, and there's the participation percentages there. Keep in mind, remember, those are created and enforced by the insurance companies to prevent adverse selection. Okay, next page, on page 39, towards the bottom of the page, number 7, there's where it talks about conversion. We can convert from the group to individual within 31 days of our ineligibility of coverage. Last sentence says, premium of the new policy shall be based on the insured's age at conversion. Number 10, most group life policies contain a facility of payments, which you might have a question on. Facility of payments basically states that the benefits can be paid out to anybody who will take on the responsibility of costs associated with your death. So they mentioned in there, may make payment to anyone who appears to be entitled to the death benefit due to their willingness to assume the insured party's medical bills or burial expenses, even though they may not be a direct insurable interest in the policy. And that's it with group. But if you're going to be here on the health side, it gets a lot more detailed, a lot more questions in group health insurance, so we'll whole section on it in that area of the class. Credit life, last page on page 40 in this section, we said credit life is decreasing term life insurance written on consumer debt up to a loan amount term of 15 years. Now, the policy coverage amount in this credit life policy cannot exceed the amount owed on the loan. And if there is any excess in force at the time, the amount over and above what's needed to satisfy the outstanding debt goes to a secondary beneficiary. Because remember, the primary beneficiary here is going to be the lender. So they say here at the first paragraph, there's a creditor involved, and then we have the debtor being the person who owes the money and has taken out the policy. And these are the policies that we're going to see sold by the bankers and the banks at time you take out the loan or an auto loan or whatever it may be. Financing department at the auto dealership, they sell this a lot as well. Now, one thing I'll mention here, although they might require that you have this in order to obtain the loan to protect themselves, they cannot require you buy it from them. That's unfair trade practice known as coercion, and it's a violation of state law. Next paragraph says, maximum policy period cannot exceed the life of the loan, as we said. Policy limit cannot exceed the amount owed. And that's basically going to be it. Now, one thing you'll want to write in there, 6-month suicide exclusion. We'll talk about suicide exclusion in the next section, but right here, credit life, 6-month suicide exclusion. That's going to be it for this section. So again, you might want to review this before you go on. This is one of the really harder parts of the course here. Before you watch the next section, again, you're going to want to read that section out of the text. Get ready before you read it, and I will see you there.